Hello and welcome to another Ola Prime educational video. In this video, I will talk to you about something that is near and dear to my heart because I use it all the time. This is the simple concept of a rectangle. When you look at a longer term chart, it's very clear to see that markets tend to go up or down, depending on the trend, go sideways for a little bit, and then continue before they eventually turn around. However, something that's very common to see in these pauses, if you will, would be the simple rectangle. It's consolidation. It's when the market just isn't moving. These can be great clues as to your next move, or, ironically enough, I know some people who trade nothing but rectangles inside the rectangle, while many others wait for the market to leave the rectangle. You can do either, but for myself, I tend to wait for breakouts, and that's what this video is about. Consolidation trading is something that people do, but it comes down to your style. I will touch on that and leave it up to you as to how you want to approach the idea of a rectangle. In front of you on my MetaTrader 5 platform, I have a 4-hour chart of the euro against the US dollar, and it is zoomed way out. And the main reason is that I want to be able to show you what I'm talking about. So a rectangle is just simply support and resistance, and hopefully you understand what that means. Basically, it just means that there's an area where traders are coming in and buying the market, while there is also an area where they are selling it, and it becomes fairly obvious over time. Now, the thing about this rectangle, we've got a solid support level and a solid resistance level, is that eventually it breaks. Now, there are two ways to approach this. Some traders will just buy back and forth. They'll buy on the bottom, short on the top, etc., until the market breaks out in one direction or the other. And the idea is that you'll make 3 or 4 or 5, maybe 6 wins, and then you get a loss. And that is one way that you can do it. I've had success doing that. However, as I typically am a little bit more of a swing trader, what I like to look for is a trend. So for example, let's just say that we were in a downtrend and we go back and forth and then we break down lower. Well, this is the old expression, if you will, consolidation leads to continuation. That's not always the case, but it quite often is, at least enough to make it a viable trading strategy. So with that being the case, when you look at this chart, you can see that there are some areas that I can mark here that are rectangles. It doesn't have to be a perfect to the pip line, but you can see there's areas where the market basically just does nothing and it goes sideways. Well, why would it do that? There's a whole host of reasons. The first one, of course, being that there's just nothing going on. It's what is known as Brownian motion. It's nothingness. Quite often, what you'll see is markets are waiting on the next piece of economic news, and this is where fundamentals come in. So, for example, maybe you're in a market that's in an uptrend, and then it suddenly goes sideways for a while, just kind of bounces around in this rectangle. A good example might be dollar against the Japanese yen, and you're waiting for the employment numbers coming out of the United States for the month, and maybe you've got 24 hours and you're on an hourly chart and the market goes sideways and it doesn't do anything, and then eventually it breaks out. That makes perfect sense. It means that the market's just looking for the next catalyst. Perhaps it's just exhaustion. We've seen that a couple of times in 2024 and early 2025 in the Bitcoin market, as the market exploded to the upside, gained like 30-40%, and then just sat still for a while because people were just simply taking a breather. There are a couple of things about these rectangles that you need to know. the most important thing is the higher the time frame, the more reliable they tend to be. Meaning that, as with all other technical analysis things, the shorter time frames tend to be more noise than anything else. And that makes sense if you think about it. It takes a lot less to move the market 30 pips back and forth on the 5-minute chart than it would to say maybe move it 400 pips on a weekly chart. There's a lot more trading going on in the weekly chart, so it all makes sense. So what I typically do under most circumstances, and there are the occasional exceptions, but what I will often do is I will look for a trend, and then I will look for sideways action. So I'll go ahead and take a look at this chart here. I would also point out at this point, you can see that we pulled back, consolidated in a rectangle, and then broke higher. It went against the latest move. However, once I start drawing these rectangles on this chart, you'll start to see something very interesting. So, for example, it is worth noting that over time, you start to see these little areas time and time again. So the rectangle that we have that occurred on the pullback is actually matched by a rectangle on the way up. Notice how we broke out, came back down, broke out, came back down, broke out, came back down, and retested the resistance multiple times as we went higher. That's what is known as market memory. Another way to think about this is to understand that this is really all you're doing when you're putting horizontal lines on the chart. So for example, let me go ahead and change that to a solid line. You can clearly see that there was resistance there. You can clearly see that there is support down there. Resistance there that later becomes support on the breakout. And you'll notice over time that markets get very noisy around these levels. Quite often, they are at round levels such as 1.07 in this case, or 1.0750, etc. So that's really all you're doing is you're looking at horizontal lines and you're trading back and forth. However, the more obvious the rectangle, the more interesting it becomes to me. So here is an example of pretty significant support right around 1.0450 and pretty significant resistance right around 1.06. So it's about a 150 pip range of support and resistance, consolidation, if you will. Notice that we plunged and we came back to this previous resistance area, and that became the top of your rectangle. Once you break down from the rectangle, the beauty of this is there's a built-in measuring stick. Your target is the height of the rectangle. So in this case, 150 pips. And you can see that we did, in fact, get it. It took a minute, but we got down there. We even tested the bottom of the rectangle after this massive impulsive candlestick, which this brings me to my next point. When you get a breakout of a rectangle, really what you want to see is a solid close well under or above it, depending on which direction you're going. And in this case, what I really like about this is it goes with the downtrend. We came back, we retested this previous support and now becomes resistance. So you could have sold it on the retest and then you have your target. Your stop loss would have been very simple. You want at least a 2-to-1 ratio on what you're aiming for compared to what you're risking. So halfway through the rectangle is literally 1 unit if you're going for the entirety of it. So you're risking 1 to gain 2. It's built in. It's pretty straightforward. It's one of the reasons I like it so much. It's so mechanical. Now, you would have gotten more, and you'll find quite often that actually is the case. that you can find yourself getting more than you expected. But you know, it is what it is. So this works in all markets, in all time frames. Although, like I said, the first thing that I would say about shorter time frames is they're a lot noisier. You can see it would be a little bit more difficult here in the DAX on the 5-minute chart, although there are rectangles that occur. But you really want to pick and choose the rectangles that you get involved with. So for example, let's go ahead and take a look at this rectangle, which is right around 13,150 euro on the bottom, 13,225 euro on the top. Notice that the market had been falling all the way here and then we broke out. You definitely got your target, but this is what I was telling you about earlier. Sometimes consolidation is the beginning of the turnaround. The turnaround didn't last that long. There must have been some catalyst that fired off here to get people excited. They must have been waiting for something. They got it, and then the market thought about it for a while and changed its mind. So let's go back to the daily chart. And you can see that there are numerous times, let me go ahead and zoom in a little bit, where the market has been sideways. Here is a perfect example. Big, huge rectangle here. You can also say that there was a double top here in this rectangle. So everything's lining up. We finally break down below the 15,000 euro level decidedly on this candlestick here. We plunged, so you would have hit your target almost immediately. But even if you didn't catch it, what was once support now becomes resistance, and then you hit your target down here. So you can see just how interesting and how powerful these can be. It just comes down to whether or not it goes with the trend or if it goes against the trend. But trends very rarely do what is known as a V bottom. Here's one right here where we've started plunging and then bounced. But more often than not, you see these rectangles. When you see consolidation like this, you have to think about, is something going on? It should catch your attention. Let's go ahead and take a look at something a little bit. Let's see, let's just do gold. So notice here, we fix the auto scroll here. There we go. Notice here, the market had gone sideways for what seems like a lifetime. So let me go ahead and put my rectangle here. Now, there is a wick that breaks through the rectangle in the very beginning. I don't read too much into that, mainly because it was rejected so soundly. Like it didn't stick, so it doesn't change the overall consolidation. This is part of where experience comes into play. But notice this market has been rising. It went sideways for a while, and then we had a really strong close that day. We closed towards the very top of the candlestick, and that tells me a lot of things. It tells me, number one, we broke resistance, but it also tells me people went home that day holding gold. And that's information you need to know. And you can see that clearly we had rallied pretty significantly from there, and you would have gotten your profit. So let me go ahead and look for another example. Here's an example here where we have a triangle, or excuse me, a rectangle. We had a triangle that broke down to a rectangle. That's actually what caught my attention. And now, as I look at this, remember I said that some guys make all of their money just trading back and forth. Well, what they'll do typically, and again, I'm not a huge fan of this, but I've seen it work and I have done it. But what they'll do is they'll do something like put a stochastic oscillator on, recognizing that sooner or later they're going to lose money. So we rally, we hit resistance, we cross over there, we fall, we cross over here, we rise, you short there, and then eventually you lose. So you get 2 or 3 gains, 1 loss. If you're risking the same amount every time, that's the theory. Again, not a big fan of that. A lot of times what I'll do, if I do anything like that at all, I'll just go with the trend. But I have found it's easier just to go with momentum. Markets are momentum driven. And that's exactly what breaking out of a rectangle shows you. It shows you that the momentum is moving.